Hey everyone, and welcome to this explainer. I am so thrilled to have you here today. We're going to do something really fascinating right now. We're taking a journey that starts way up in the stratosphere of macroeconomics, looking at the massive global machinery that literally funds entire nations. And then we're going to bring it all the way down to ground level, straight to your personal financial security. So get ready, because today we are completely demystifying the bond market. $145 trillion. Just let that sink in for a second. That is the sheer, mind-boggling scale of the global bond market right now. To put that into perspective, it's actually larger than the entire economic output of the whole world in a single year. We're talking about a staggering amount of wealth just flowing through the financial system, quietly making the modern world possible. Which brings us to a pretty provocative question. What is the invisible backbone of the entire global economy? Look, we constantly hear about the stock market, right? Tech startups, real estate. But the truth is, the global economy fundamentally runs on debt. More specifically, it runs on government and corporate debt. So how does this invisible backbone actually work? And more importantly, why does it matter to you and your wallet? Let's dive right into Section 1, the global IOU market and the sheer scale of bonds. Remember that $145 trillion number? Well, it actually completely dwarfs the global stock market. It towers over the $127 trillion equity or stock market. Everyone usually focuses on shares, obsessing over daily stock prices on the news. But bonds are the quiet giant in the room. They are the true heavyweights of global finance. And the concept itself is beautifully simple, and honestly, incredibly old. This fascinating history goes all the way back to 1172, when the Republic of Venice issued prestiti, basically forced loans just to fund their defense. Fast forward to 1694, a syndicate of investors actually helped fund the Bank of England to pay for the 9 Years' War. And then in 1776, private citizens bought bonds to finance the American Revolution. For centuries, governments have used these IOUs to build nations and finance wars. Ultimately, when you buy a bond, you are the lender. Moving on to Section 2, prices, yields, and curves. Let's decode some of this financial jargon. Okay, so the most common term you're going to hear on the news every day is yield. Simply put, when you buy a bond, you are lending your money to an issuer, like a government or a big corporation. The yield is just the effective return. It's essentially the interest rate you're paid for providing that loan. Think of it as your reward for parting with your hard-earned cash for a set period of time. Now, to really grasp this, think of the famous seesaw analogy. This is literally the golden rule of bonds. Bond prices and bond yields move in opposite directions. Always. If the price of a bond goes up because demand is super high, well, its yield goes down. Conversely, if the bond's price falls, the yield has to rise to attract new buyers. They are forever locked in this inverse seesaw relationship. All right, Section 3, the ultimate safe haven. Let's talk about U.S. Treasuries. Looking at global foreign exchange reserves, you see something super interesting. Despite massive global economic shifts, crazy periods of inflation, shifting trade tariffs, all the geopolitical fragmentation out there, central banks around the world still hold roughly 57% of their reserves in U.S. dollars, heavily via U.S. Treasuries. The euro sits at about 20%, and the Chinese yuan is down around 2%. So the U.S. dollar is absolutely still the dominant force. But why? Why is that immense trust there? Well, the U.S. generates about 22% of total global output. That means the U.S. government has the ability to tax a massive, highly productive economy. It's actually this tremendous, high-quality tax revenue stream that backs U.S. debt. And that is exactly what makes it widely considered the safest, most reliable financial asset on the planet. Let's take a quick detour into Section 4, corporate versus government bonds. We need to compare our borrowers. When you look at it, the differences are pretty clear. You're either lending to a nation that's backed by its taxing power, which, as we just saw, is lower risk and therefore offers a generally lower yield, or you're lending to a private company backed only by its corporate profits. That obviously carries a higher risk of default, and because of that, it generally demands a higher yield to make it worth your while. Though actually, it is worth noting that recently, corporate yields have sometimes converged really closely with government yields. That forces investors to really weigh if that tiny bit of extra return is worth taking on that added risk. Now let's bring this closer to home in Section 5, the retirement danger zone, and something called sequence of return risk. So have you ever heard of sequence of return risk? Honestly, it is arguably the most terrifying vulnerability for any retiree. It's the danger of experiencing substantial investment losses in the market during the 5 years just before you retire or the 5 years right after. Think about it. If the stock market crashes right as you start withdrawing money to live on, you are permanently wiping out shares that will never ever have the chance to recover. And here is the crucial point, this staggering statistic. Research shows that nearly 70% of all retirement failures, and by failures, I mean people totally running out of money, 70% are directly linked to experiencing investment losses in those initial 5 post-retirement years. Timing is quite literally everything, and a bad sequence of returns early on, it's absolutely devastating. Which brings us to our final section, Section 6, Building Your Bond Shield to Protect Your Wealth. So how do we fix this? We can actually use stable bonds to solve that terrifying sequence of return risk using what's called the 3-bucket approach. Bucket 1 is your liquidity reserve, basically 1 to 2 years of cash for immediate needs, no risk there. Bucket 2 is your income bucket. This is where you keep 5 to 8 years of living expenses safely locked into stable bonds. And then bucket 3? That's for long-term growth. Those are your equities and stocks that you just leave untouched for years, letting them ride out market volatility to preserve your future purchasing power. And you know what the absolute hero is for that middle bucket, bucket 2? It's often a specific type of bond called TIPS, or Treasury Inflation Protected Securities. These things are brilliant. They are government bonds where the principal value actually adjusts upward with the consumer price index. So if inflation goes up, the value of your bond goes up too. Your retirement income literally rises to match inflation. How cool is that? But look, to be a fully informed investor, you need a balanced understanding of the asset class. Bonds aren't completely risk-free. There's no such thing. You have credit risk, which is the chance the issuer just flat out defaults. You've got currency risk if you buy foreign bonds and the exchange rates shift on you. There's inflation risk, where your fixed payments lose purchasing power over time. Well, if you don't hold tips, that is. And finally, interest rate risk, where rising new interest rates cause your older, lower-paying bonds to actually drop in price. Which leaves us with a final, pretty powerful question for you to reflect on. Is your portfolio really built to weather the global financial storm? We've just seen how the massive mechanics of a $145 trillion bond market literally dictate global finance, and exactly how those same secure, yield-generating instruments can be structured into buckets to completely shield your own retirement. Thank you so much for joining me on this explainer. Now, it's time for you to go take a much closer look at your own financial backbone.